KEC International, and that's surging in trade after reporting a good set of numbers. The profit after tax for the company has gone up by 451%. Also, the order book is at a record level and the L1 position is close to about 38,000 crore rupees. To talk more about the way forward, we have Vimal Kejriwal, the MD and CEO of KEC International, on the show now. Mr. Kejriwal, the first question is on your operational performance. At the EBITDA level, the company's clocked in margins of 6.2%, which is much higher than the 9-month EBITDA margins of about 6% or what you had last year. Could you explain what's contributing to this margin increase, and can it continue to rise from here on?
Well, good afternoon. I think there are two basic reasons. One is last year's numbers and all, we had SA losses, etc., which are now under control and we have started making money. Second is most of the legacy orders are getting over. So, and if you look at our order intake of almost 13,000 crores, these are clearly at a higher margin. So once you start, the execution starts kicking in from these orders, the margins are bound to improve. And that's what is happening. Last 6 quarters, our margins have been, inching up.
Okay. Can you just give us what exactly the pipeline looks like when it comes to tenders, and what can we probably expect in terms of incremental order inflows for you?
So if you look at the tender pipeline across our various businesses of T&D, civil, railways, etc., we are today sitting on a pipeline of roughly around 1,30,000 crores. Some of it has already been tendered, which has not been opened or reserved, and some of which will tender in the next maybe 1 or 2 months. So it's roughly 1,30,000 crores of tender pipeline.
Okay. So what is the conversion rate that can probably be expected? I'm just trying to get a sense in terms of how robust FY25 could probably look for the company when it comes to an order book.
FY25, my guess today is that we should have an order book of roughly around, order intake of roughly around 25,000 or maybe slightly above that. So typically we have been seeing that we win one out of 6 orders. So if you convert that 1,30,000 that way, so should be around 25 or so as a ballpark figure.
Mr. Kejriwal, I was just trying to recall our past conversations, and I believe you had guided for margins to improve to 8% in the second half of the year. So do you think Q4 exit margins could hit 8%?
So Q4 exit, we are trying to do that. I hope we can exit at 8%. But right now it looks a little bit difficult, to be very honest with you. Maybe 25 basis points or something here and there is what should happen. We'll not be way off the mark, but I think we'll be slightly below that.
Okay, so Q4 margin should be closer to 7.5% and not 8% as you had perhaps anticipated.
I said Q4 exit, I said should be around that. Okay, Q4 margins will probably not be 7.5%.
Okay, got it. And what about the net working capital days? While it has improved, your target was 110 days by Q4 of FY24. Where are we on that?
We are still on that. We should be able to reach 110 days by end of March. Definitely our closing on March will be at 110 days or maybe below. That's what we are targeting.
Okay. What took place in the railways segment? The order intake was around 850 odd crores. It was qualified as a little bit of a subdued order intake. Can you tell us what's taking place within that segment? Is there a slowdown seen? What are you anticipating?
So what has happened, there are 3 or 4 major, I'll say, structural changes which has happened in the railway EPC business. One is it has shifted from being a BOQ basis where, you bill and for each quantity has become a EPC sort of business. So where the risks have increased. That's number one. Number 2, the clientele which used to be people like RVNL or RITES or IRCON have now changed into the divisional railways. And we are actually competing with RVNL, IRCON in every tender. So that's to me is the second piece. Third piece, I think, is that with road sector, I don't think there are so many tenders coming out. So a lot of contractors from road sector have been bidding in the railway sector, which has increased the competition significantly. So I think these are 3 or 4 factors which have impacted, and we have consciously been sort of staying away from that sector because of the slow, I'll say, execution and also the cash flow issues which we are facing in the current orders. So that's why it's a much, I'll say, very conscious decision to, degrow the railway order intake, etc.
But subsequently, you're looking at the international segment or opportunities within that space?
Yes, I think we have already bid for a few projects in Bangladesh, in Middle East, etc. And I'm very sure that we should get one or two orders. In fact, we already started executing one order in Bangladesh in railways, and we should get some more.
Your guidance on the top line is 12 to 15% for the full year, FY24. You're tracking ahead of it at 17% top line. So for the full year, would you like to revise your guidance higher on revenues?
So I think we should cross 15%. I think broadly, if you look at numbers, we should be doing around 20,000 crores. That's the number which we are looking at, which will be slightly above 15%.
Above 15%. Okay. So top line growth, 15%. Net working capital should be down to 110 days. Okay. And on an average, margins for FY24 will be closer to 7%?
So 7 is what we had said. I think with the situation, what is happening and some of the orders and all that, and the little bit of impact of Red Sea, etc., we should be maybe 20-25 basis points below that for the whole year. Yeah.
Okay. Just give us, sure. Go ahead.
Okay. And Q4 is typically a stronger quarter, right, in terms of order inflows? So what's the expectation of it? Yeah.
Sorry. So we have one is we have a 8,000 crore L1. And I think a large part of it will get converted in Q4. So today our order intake is around 13,000. I think 8,000 is our L1. Plus, I think bid for a few more projects, especially on the India T&D piece, which we expect to, convert them. So I think we should end the year at probably 22, 23 or something like that. So we should get another 8 to 10,000 crores of orders in Q4.
Okay. Just on the international space, you did mention fleetingly that, there is some impact of the Red Sea. Can you quantify it as an impact? Is it impacting maybe your input costs to a certain extent because of freight costs? What does it do to margins, say, going into FY25? Is it a significant risk to the business?
So right now, the impact is very marginal. We don't import anything from that region, so it's not impacting my input cost. But I think what is happening is that we do have a Saudi market. There's some exports going from India to Saudi. Plus, we have got exports coming in from Europe into Saudi. So I think right now it's a marginal impact. But I think the problem is slightly different. The problem is that the voyage times have gone up. So typically, the voyage times have gone up by 30 days to 60 days to most of the places, even if they're not in the Red Sea. Like my voyage to US and all that, the turnaround times have been going up. Ports have been becoming a problem. So I think it's more on the timelines than on the costs. Costs are there, but right now I don't think I'm seeing any significant impact of costs. But it's impacting the revenue itself, where the shipments are getting delayed, and you're not able to book revenues. So that's the part today.
Okay. All right. So we're going to leave it on that note. It's been a pleasure speaking with you. A lot of details coming out from KEC International. As you can see, the stock is up around 5%, quite optimistic in terms of order inflow going into FY25 as well. And, more details on your screen. We'll take a short break. On the other side.